Maximize Business Value podcast. This podcast is brought to you by Mastery Partners, where our mission is to equip business owners to maximize business value so they can transition their business on their terms. Our mission was born from the lessons we've learned from over 100 business transactions, which fuels our desire to share our experiences and wisdom so you can succeed. Now here's your host, CEO of Mastery Partners, Tom Bronson.
Hi, this is Tom Bronson, and welcome to Maximize Business Value, a podcast for business owners who are passionate about building long-term sustainable value in your business. In this episode, it's part of our series called Tales from the 17% Club. As we've said over and over again, a full 83% of attempted business transitions fail to reach the finish line, meaning that only 17% of them are successful. So in this series, we interview the people who have successfully transitioned their businesses. We call them the 17% Club, to learn more about the process and hear some interesting stories along the way. You won't be disappointed today. In this episode, I'd like to welcome our guest, Randy Haran. He's the founder of Normandy Capital Group and president of the Business Crusader. I first met Randy at, of all places, a baseball game when I was there with my friend and past 17% Club guest, Mike Rose. After that introduction, I knew that I needed to get Randy to share his story with you here. Randy served as president and CEO of Texas Air Composites, or TAC, one of the nation's leading FAA authorized repair centers for composite structures. Haran co-founded TAC in 2000 along with his brother Michael, and they sold the business in 2014. Now, with a style that reflects more Jimmy Buffett than Warren Buffett, Haran infused TAC with his own brand of energetic leadership, spirit, and vision over the years. This unique style of management is based on a passionate belief in open book management, OBM, which encourages each employee to really understand the inner workings of the business and thus become truly invested in the success of the company as a whole. That is a quality that I admire greatly. So welcome to Maximize Business Value, Randy.
Thank you, Tom. Appreciate it. Thank you very much.
It's good to have you with us. So give us a little background on Texas Air Composites.
We were an FAA repair facility. We started the company in 2000. When you look at an FAA repair facility, kind of look at us as a car body shop. So the airplane didn't come to us, but the components on the airplane. And the type of components that came to us were either metal type structures or composite structures, composite being fiberglass, graphite type structures. Anything on the wing or the tail and around the engine, in front of the engine and behind the engine. And then also from an interior standpoint, we did the floor, the walls, the ceiling, the bathroom, and the kitchen of the airplane. So for major commercial and regional airlines, such as Southwest, American Delta, American Eagle, SkyWest, to name a few. And we also did a lot of work with some international airlines as well.
So I imagine that you and Michael didn't just wake up one morning and decide, hey, that'd be a pretty good business to be in. Let's go start doing How did you guys get in? Or I know you started the business, but how did you get into it?
My parents had a company. My parents, the reason why they came to Dallas back in '63 was out of Wichita, Kansas. My father had worked for a machine shop specializing in doing stuff for Bell Helicopter. So that company picked up and moved everybody down here. So my father had kind of come up through the aviation business, and he and my mom started their own business in 1973. So we pretty much grew up in the aviation business.
I was going to say you're not an accountant for years and decide you want to make precision airplane parts. So I knew that there had to be some more to that backstory. So you and your brothers sold the business in 2014. Let's talk a little bit about that exit strategy. Did you guys have an intentional strategy to sell the business, or did it one day something just, as we say, fall in your lap?
It's funny you say that, Tom. In 2005. Prior to that, I was kind of at that typical owner where it was my baby. It was about me. It defined me. It was all me. And in 2005, I went to an M&A seminar, and I'm sitting in the seminar. It's an aviation company. These guys, get you there and they kind of educate you, and they're looking for candidates to sell. And everything I thought you should act as an owner was the way you're not supposed to act. It was more like where you would attract an economical buyer, where you weren't having forecasted financials like a pro forma. You were basically working off your tax returns. You were talking about yesterday, everything in the rear view mirror. And so I'm in there, and it just says the emotional guy, the guy that it's about him, gets less. The guy that makes it more about the company being the product, and because that's what they're buying. They're only going to have you around as an owner for a short period of time, as much as they need you. But ultimately, that's their company, and they're going to do what they want to do with it. So that M&A seminar really slapped me upside the head. And then at that time, I in 2006 reached out to a M&A merger and acquisition type company and looking for a guy that specialized in aviation. And that's the guy I found. He ultimately is the guy that sold my company. So, and he educated me on the fact that if I wanted a 7 to 10 multiple, you needed to be around $5 million from an EBITDA standpoint. So he kind of gave me that goal of how I needed to run the business and what I needed to focus on.
Well, it sounds like attending that event in, what did you say, 2006?
2005.
2005. I mean, that was kind of a pivotal event for you. So many business owners, even today that I talk to, say, oh, my business is my baby. Well, okay, I know that you care and feed it, right? Care for it and all that, but it's an asset. It's really something that you should be thinking intentionally about improving the value of the asset. And when you treat it like your child, then sometimes you don't do that. I can tell you, even with my own children, sometimes I'm protecting them more than I'm trying to help them grow. Right? It sounds like that was a great. Right. Pivotal event. And then you met somebody, shortly thereafter that you had an 8-year relationship with then before you actually sold the business. And getting that great advice early is such an integral part of a successful transition. Well, what was the trigger in 2014 that made you guys decide, okay, it's time, we're ready?
Our business was getting close to that $5 million EBITDA. We'd kind of done a dance in 2013, 2012, I guess it was 2012, 2013 timeframe with another company that it kind of came and was interested in us. Fortunately, we didn't sell to them at that time, but we at least got to go through the dance and kind of do a dress rehearsal on the due diligence process, what type of questions to expect, what kind of ways that we should think about things. And so, and then some of my other partners were kind of keen on wanting to sell, but I didn't want to do a kind of like an emotional sale or just, I'm tired, I need to go something else sell. I wanted to do more of a strategic type sell. So that's kind of where everything kind of came together in 2014, from our revenue, from our profitability to the market, and just kind of all came together at that time.
Harmonic convergence of kind of all of the elements in the right place. So the 2014 was the transaction time. About what time of year was that? Do you recall?
We sold in December. And these guys had done a drive-by before, but when they'd done the drive-by before, they were more acting like a financial buyer instead of a strategic buyer. So when they had drive-by before in 2013, I had told them I wasn't interested in a financial sell. So there's no sense for us even having a conversation. But they had, I saw them at a conference in late April of 2014. And I told them that I planned on going to market in the fourth quarter. And then like the next week, I had the CEO wanting to have dinner.
Of course. All right. So you just gave me a new term, and I love that, a drive-by, right? I hear all the time from business owners, oh, my business is going to be so easy to sell because people call me all the time wanting to buy my business. And I've explained to them that if you're breathing and you actually have an operating business, people are calling you, and they're not necessarily buyers. A lot of times they're just fishermen, right? They're looking for something to sell, or just kind of gauging interest. Sounds like your drive-by originally turned into a great opportunity to sell the business. But were you getting lots of calls before you decided to sell? I mean, during those years between 2005 and 2014, were folks calling you wanting to buy your business?
Yeah, it's funny you say that, Tom. So yes, I would get I would also always get the economical buyers. They would always kind of touch base and drive by. But my line was, I just always say, well, I'm just kind of waiting another 5 years. I just gave them the same old line because I didn't really know. That's just a line I gave them when when they would do the drive-bys.
Yeah, that's great. So many do. I think if you put 100 business owners in a room and individually ask them, when do you want to sell your business? The 98% of them are going to say 3 to 5 years. 3 to 5 years. But the problem is most business owners say 3 to 5 years for an average of 17 years before they actually go and do something with it. So I'm glad you didn't go that long saying that. But so your process, you mentioned this in April, and then the CEO wanted to have dinner with you. So it really went from about May to December, right? So what is that, 7-8 months?
Right. Yes.
That's excellent. Now, you mentioned already that you had an investment banker or somebody, an M&A advisor to help you. What did the rest of your transition team look like? I mean, did you have attorneys, CPAs, financial advisors, all of that stuff?
Man, I had a great team. And I'm glad you asked me that question because back in 2006, through the entrepreneur organization, we were teamed up with YPO, and I was able to meet a mentor. And that particular individual introduced me to another guy that was in YPO that would ultimately be my business advisor. And he would help me up from 2006 all the way to 2014. There was like a 1 year where he got caught up doing some other business, but he came back. But yeah, towards my last year, 2 years in business, he was kind of my fractional CFO and my business advisor, and would be at our board meetings, and he was an advisor to the board. And he had a financial background. He'd also taken companies public. He had bought and sold companies. He was very, very well versed in pretty much anything and everything. He became the quarterback. So he kind of was the front guy, and I'm going to call him kind of the strategy guy. Then we had and he's kind of one introduced me to the attorneys that he had worked with in the past from an M&A specialty. And so we had a special M&A attorney, but we also kind of had a junior attorney, to kind of level out the hourly rates and that kind of stuff. Then I had my accountant. My accountant was amazing, and I'll even have a better story for him later in the podcast or whenever you're ready for that. And then I also had one of my board members who had a company. He kind of ran his business at my facility, and he was one of my vendors too. He kind of ran the due diligence. So he ran the data room and ran all that. So, and then my M&A advisor. So it was, from a team standpoint, from me not necessarily being involved in the day-to-day and being able, because as you well know, a lot of founders and CEOs, when they go through the M&A process, they get dragged into it. And if they don't sell the company, a lot of times their business suffers because of it. And I did not have that problem. So from a team standpoint and ultimately getting the deal that we got, that was that group.
That's awesome. So I have to ask, unless you want to talk about it later, I have to ask, tell me the story about was it your accountant that you said you had an interesting story about? We had a quality of earnings audit, and they couldn't find anything. Wait a minute. Did the buyer did the Q of E?
Yeah.
Okay.
Yeah. Right. He sent some, I don't know how many accounting firms, if we're still at the big six or big four, or big three or what, but they had gotten some of those guys and guys that specialized in going through the financials and devaluing the company. And my business advisor, the quarterback, and the accountant did the dance, and it was just, they couldn't find anything. So, they just got slapped around. And I was told that's very rare. So again, making previous decisions, I think we had in '08, we had a partnership breakup, and part of the breakup was a buyout of partners that were leaving. And part of the agreement was that we had to start doing a third-party audit every year. And so from that perspective, but also we had changed banks in 2013. So we had a bank audit that we had gone through. From our inventory was clean, crisp paperwork, market data to support the pricing and all that kind of stuff. So we were just kind of ready to be sold. I mean, you couldn't have asked for a better situation.
Well, I got to tell you though, it's a smart play. Too many business owners really don't have that whole team approach. Now, you had a board member on there, your fractional CFO, attorneys, accountants, all of this, and of course the investment banker. Did you all meet together kind of regularly during this process, or was it you had your CFO quarterbacking the deal? Was he just coordinating it, or did you all get in a room and talk about things a lot?
I'd say the team that would get together and coordinate would be the quarterback, M&A advisor, and myself, the board, the due diligence guy, and my brother. That was kind of the key, and we would reach out to other people. But during the Q&E, that's when the accountants shine. The M&A lawyer, the lawyers shine during the final negotiation process. So everybody but the consistent team was the quarterback, the M&A advisor, and the due diligence board member.
You said a mouthful. I just recently had David Hammer, who is an attorney, CPA. He's an M&A attorney, and I caution so many business owners that if their chief counsel is just a business attorney or a litigator or tax guy or whatever, you really need somebody who's experienced in M&A transactions, because the language is very important in those types of agreements. And you want somebody who really specializes in that. It sounds like you had a really great guy. Now let's talk about, you had a board member kind of running the data room, the due diligence process and all of that. And I commonly say that while due diligence on its face value is really the buyer verifying, what the business is and what they're buying, I think that due diligence is really designed to find ways to lower the price, right? It's like that Q of E, right? When they do the Q of E. So I call it the dreaded due diligence process. How did your due diligence go then?
We had, so because of the dress rehearsal that we'd gone with another company trying to buy us, so we'd already kind of done the dance in the data, and this company was a public company that we did the dress rehearsal with. So their requirements, their questions, from all that perspective, were pretty lengthy and detailed. So we had kind of already gone through the dance. So, and getting set up, we'd already kind of understood the do's and don'ts. So from the actual exit, we were ready and knew, and already had things in the different buckets that they needed to be in.
That's awesome. So many times businesses aren't ready and due diligence just drags on, and having that, what you call a dress rehearsal, is so important, right? Getting that stuff ready in advance. So since you'd already been through a process sometime earlier, going through it a second time had to have been that much easier than to gather that data and get things prepared. My mom used to tell me, when I was a teenager and just learning to drive, that speed kills, right? Don't be driving so fast. But speed kills also in M&A transactions, but meaning the opposite. The slower the due diligence goes, the more likely a deal is going to fall apart and it's going to crash somewhere. And so good on you for having somebody kind of running that data room and making sure that you had all this stuff going very quickly. Now, a lot of times from the letter of intent, here's what we intend to do, to the actual transaction, in the middle of there is the due diligence. A lot of times it detracts from value, and that's sort of what I call that retrade conversation. What happened from the letter of intent to where the actual transaction landed? Did it add or detract? And did you have that retrade conversation?
It's funny you say that. They had they did the old earn out, the funny money. Mm-hmm. So they had the initial cash offer, but they added another, millions up on for earn out potential. And so I had a number, and they were significantly lower than my number that we were going to take from a net standpoint. And so when they came, we kind of my quarterback said, "Hey, let's dance with them a little bit," and just then we kind of danced a little bit, and then we countered. I guess about 60 days into the LOI or something like that, and we were able to pick up half of the earnout money, which got to the minimum number that I wanted. And then ultimately, before we actually closed in the last, day of negotiations, we were able to pick up more of the earnout to even get higher. So from the LOI standpoint to the actual agreed upon price, we rose it up, almost 30%.
That's awesome. Now that money was already kind of allocated to earnout, but you were able to get it moved to the closing table, is what I'm hearing.
Yeah.
That's awesome. Sir. I tell so many business owners. In fact, I just had a conversation this morning with a fellow advisor who said a piece of advice that I had given him really resonated. A client of his just sold, and it was, they had a publicly traded company looking at the business. There was a massive earnout, opportunity and all this. And I said, look, if you're not happy with the amount of money that changes hands at the closing table, as if you're never going to get another dollar, then don't do the deal. And he said that that's what actually drove their process. And they were happy with what they got at closing, and they have some earnout potential. So you still had some earnout opportunity after you closed, right?
No, we had closed it where we got about, I'm going to say about 90% of the cash up front. And then over a 2-year period, we got quarterly payments. What my quarterback had realized, he realized how much money they were going to get from the financing standpoint. So the last major negotiations to go after the second half of the earnout money, we didn't get all of it, but we got most of it. But he said we got it for a 2-year payout would help them because they could use it, with cash flow of basically the money that we were cash flowing as a business. So we were able to meet where they needed us to be from a financial perspective. And then after that, there was no earnout, no nothing. So for day one, it was their baby. And so.
Yeah, that's all right. So yeah, there's a big difference between earnout money and escrowed or guaranteed, payment money. And many business owners don't understand that. We actually talked about that a couple of weeks ago with David Hammer when we were talking about that. Not all of the post-transaction money is created equal. Sounds like you guys did an amazing job of getting that done up front. So and good for you for getting that future money, brought back to the table. So and having that number in mind, right? Knowing what that number is, and your shareholders kind of all agreeing on what that number is, it keeps everybody moving in the right direction. Before we take a quick break, I'd love to, how many employees did you have at the transaction time? 90. So how did they react, and how did the transition affect them, down the road?
That was if there was a little disappointment, some of it from that perspective. They once we announced the sale of the company, they were kind of caught off. I mean, they congratulate and that kind of stuff, but they always have that, what about me? What's going to happen? What are they going to do? It's always the stuff, the unknown that they don't know, that your mind starts going down. And they kind of came in, and they had the famous quote, "We're not going to change anything." And of course they did. And they had a big ERP implementation. And unfortunately, treated my 2 main guys that kind of, my director of sales and marketing and also the director of ops, which were the kind of the backbone of the success of the company, they kind of put those guys on the sidelines. And it's funny, after a couple of 2 or 3 years after the buy, they really drove the value of the business down. And again, I shared my financials. So these guys were starting to make my guys accountable to the numbers. And the guy goes, how can I be accountable to numbers when you don't let me look at the numbers anymore?
Yeah.
So,
yeah, totally.
And I got calls from consultants they used 4 or 5, probably the third or fourth year. And he said, they used your company as what not to do when they acquired future companies, because you had a good culture, you had a good system. That's the reason why they bought you, and they got rid of all of that.
Oh,
so
man, that what a horrible story. But not an uncommon one. You mentioned that, we're not going to change anything. After in the 90s, I sold a business to a publicly traded company, and I went to work for them, and I was temporarily kind of the integration guy, right? And so, they were negotiating deals, and they'd go buy a company and telling them all, we're not going to change anything, blah, blah, blah. I was the guy that arrived the day after the transaction to meet with the employees. And my common line was, I know they told you that we're not changing anything. I'm here to tell you the truth. And here's what's going to happen. And of course, it was sometimes different reactions. I will tell you, selling my company to that publicly traded company, fortunately, my employees, who were really well groomed and doing great jobs kind of throughout all of our operation. We were a big company in the Southeast and had lots of locations. Many of those guys went on to have brilliant careers with that publicly traded company, many of them taking giant, regional and national roles. And so I was super happy for that. But you're right. Things change. And if any business owner thinks when he sells the business that nothing's going to change, I have a different story for you. So we're talking with Randy Haran, and he's a member of the 17% Club. Let's take a quick break. We'll be back in 30 seconds.
Every business will eventually transition, some internally to employees and managers, and some externally to third-party buyers. Mastery Partners equips business owners to maximize business value so they can transition their businesses on their terms using our 4-step process. We start with a snapshot of where your business is today. Then we help you understand where you want to be and design a custom strategy to get you there. Next, we help you execute that strategy with the assistance of our amazing resource network. And ultimately, you'll be able to transition your business on your terms. What are you waiting for? More time? More revenue? If you want to maximize your business value, it takes time. Now is that time. Get started today by checking us out at www.masterypartners.com or email us at info@masterypartners.com to learn more.
We're back with Randy Haran, a business owner who successfully sold his business in 2014, therefore making him a member of the 17% Club. So Randy, you kind of gave us the story of the transaction and all that before the break. Let's kind of talk about the things that you learned. What did you learn going through this whole process?
I guess just it's all about a story. If anything, you're telling a story, and you're telling a story about your business, and that could be a 5-year, 10-year, 20-year type story. And fortunately, we had always kind of documented an annual plan, a plan that consists of a sales forecast, financial and operational metrics. Also talk about what we did right and what we did wrong. So there was those key things that you kind of talked about when we slipped or the business went down in 2010. It went down significantly, and what did we do to turn the business around to get the business to go back up? So that story, fortunately, was being put together every year, just because the process and the plan was not put together every year by the CFO. It was put together by pretty much the whole company. Or every employee had a a role in the development of the annual plan. So if anything I learned, you're telling a story, and that story is being told. And if there's bumps in it, or there's I don't knows, or there's, well, I think that's the way we did it. Heck, I can't remember. That was 5 years ago. And I just, you've moved the conversation and the negotiating process to a very just there. And you got to bring that history and that story and that consistency and then the ups and downs to the negotiating table. And say, no, this forecast or what you're buying and what we think we're going to do has the data to support it. So the value is what the future shows.
That's awesome. I love that whole story building analogy, because that's really, if a well-run company is writing their story year after year, right? And so every year might be a new chapter, and every chapter, by the way, needs to be better than the last chapter, right? if you're reading a story. So I like that analogy, storytelling. Is there anything you would have done differently, knowing what you know now?
I think I would have gone out and auctioned to more buyers. I got the money. I got more than I wanted. So from an ego perspective or a goal perspective, I got more than I ever thought I'd get. So box checked, done well. However, there's always that, what would have happened to the value if I would have put it out and would have allowed other companies, even companies I didn't even know, have an opportunity to look at us and see if they, what they thought our value was. I think that would have been interesting.
Yeah, and that's a whole different process, right? And I'm sure your banker would have been happy to walk through that. I mean, good for you guys that you got kind of the number that you were interested in, but you'll never know, right? It's like trying to get, how many licks does it take to get to the center of a Tootsie Pop? The world will never know how much you could have gotten, but a well-run auction process, they call it. I hate that term, but a well-run process to sell a business is always going to deliver. Well, not always, but many times it's going to deliver a different result. And it's unusual to have one buyer and see it all the way through. In fact, one of my mentors always says, Tom, if you have one buyer, you have no buyers, right? But you had a truly interested buyer, a strategic buyer that really was interested in the business, and you guys set your goals and you did that. It would have been kind of an interesting side note to know. You almost wish, can I turn back time and see what would have happened if I'd done this differently? And you never know. Maybe you got the best deal possible. Right. But many buyers or sellers out there think that they already know who the buyer is. And a lot of times it's people who you've never heard of, don't know anything about, and who are interested in your business, your sector, your, whatever it is that you do. And the value of a business is really in the eyes of the buyer, right? And he's buying future cash flow based on past performance and what he can do with the business. And you never know when a buyer is going to really pay up because you've got something that he really wants. And it may not be a product. It may just be a process. It may be, how you do things. It may be the culture, which unfortunately, which was one of the things that attracted this buyer to your business. And unfortunately, they destroyed over time. That is a great, it's interesting, right? That's what we bought. And then we turned around and killed it. A very common story. So knowing these things, the things that you've kind of thought about in retrospect, what advice would you give to business owners who are looking to transition their business? It's about building a story. I touched on that. I tell them, go out and look at other companies, pay attention to when they get sell, reach out and find an M&A guy, talk to the M&A guy. I would send my financials to my M&A guy annually. And he'd kind of tell me what was hot, what wasn't, what he was seeing, just to constantly, it'd be maybe a 20-minute phone call, or I'd see him at an annual conference and he'd just swing by our booth and he and I would just have a little download. And, from that, I think you'd even said it, the importance of having an M&A lawyer.
and it's not your day-to-day corporate lawyer or your labor lawyer. Like you touched that real well. So having that, also having those third-party audits, and getting it's more expensive, but it's that third party that's already going through a process and putting stuff together. And our accounting firm, when they would go through the third party audit time, they would kind of come up with what they thought our business was worth. So that valuation and understanding the valuation, things that are in the valuation, what makes a company more valuable from marketability and stuff like that. So I just think the more you get more but more you get educated on the process and what's out there, because as you well know, it's a whole new world, a whole new industry is the M&A part. So you might be the best at building, the car, but selling the business to make cars is a whole different thing than making cars. So.
Exactly. Well, and that really goes back to the point I raised earlier that, business owners will say, I'm going to sell in 3 to 5 years, but they'll say it for 17 years. I think that the reason that they do that is that they're not educated. They haven't taken the time to really understand what the business is worth. What does an M&A transaction look like? How do I get my business ready? And because they're really good at making widgets or stirring the sauce or whatever it is that they do, they're technologists, and they don't give thought to how can I present this business to a prospective buyer and maximize the value of this business, and what buyers look at businesses. I tell our clients all the time, we need to overhaul your financials from the perspective of a potential buyer. I know you're used to seeing these 6-page P&L statements, but a potential buyer doesn't want to see that. They want to see things categorized and lumped and understand trends and things like that. But it's those things. And I think that's what delays business owners a lot, is just not knowing what to do. And that's why we're here, right, at Mastery Partners. So didn't mean that to be a commercial for our business, but let's transport back just for a second, back to 2014.
Okay.
Sitting at the closing table and leading up to the closing table, you knew it was coming. Did you have any idea of what you were going to do next after the sale?
No, I was when I saw that as a particular topic, I was happy that you were going to say that. That's something I would do different. No, Tom, I was kind of gleaning in all my excitement, drinking my own Kool-Aid, and just excited and not really knowing what to expect or what to do. My quarterback / business advisor had really, he got me ready. He goes, you're going to get upset because they're getting ready to take your business and they're going to point out some things that aren't to their liking, that could be to your liking, and you're going to take that personally. And he goes, if they can suck you in and kind of redo part of the deal and get more of an earnout or get you involved in that kind of stuff, he goes, they will. And he goes, you really need to rein in the emotion. And he goes, so you need to be prepared that you're getting ready to be told you didn't know what the hell you were doing. And so I was just clueless. And then after that, I kind of really, you get this money and it's more money than you've ever seen. And of course, there's people out there wanting to borrow the money or wanting you to invest in this or invest in that. I kind of, if I did it again, Tom, I probably would have had more of a proactive approach into investing into a business that I was so kind of burned out that I really didn't want to jump into a 40-hour week again. But I now that I know and kind of where I am now after the sell, I just think I would, if I had a business and I worked on the business and would have had somebody working in the business, I think that I would have been in a better position. And I think I wouldn't have made some of the mistakes I made in loaning the wrong people money or investing in the wrong businesses. So I didn't have a plan. And even though I'd gone out and got all these other people to help me sell the business and done a very good job, what I didn't do is get somebody that already sold the business and kind of start listening to them and have them mentor me. There you go. That's the mistake that I made.
That's some great advice. But I got to tell you, your fractional CFO kind of telling you, be prepared because they're about to tell you your baby's ugly. But because here's the thing, it's almost a trick of the trade, right? They want to get you emotional, right? But the more you can take emotion out of that, I got to tell you, of all the things you said here, to me, that is one of the top 5 things of this podcast is when it gets to the end, it's going to be emotional unless you're prepared for that and can get your emotions in check. And when it gets emotional, that's when deals fall apart. A lot of times I was talking with actually one of our clients. It was a similar situation. You had somebody you had your dress rehearsal, you called it earlier. Well, somebody approached him, wanted to buy his business, and they went through almost a year-long process of due diligence and kind of all of that. And at the 11th hour, the buyer came in and literally, 3 days before closing, and wanted to make some adjustments in the retrade conversation, I call it. And the owner got so emotional that he walked away. It just made him mad, right, for a long time. And I asked him, here we are, I have the benefit of 5 years between that time and now. I asked him the other day, I said, knowing what you know today about the process and what it looks like, and knowing that retrade was probably coming in there, would you have sold if it was unemotional? Would you have still taken that deal? And he said, without a doubt, it was still a good deal. I said, well, that's you just weren't prepared for the emotion. So good on your fractional CFO for getting you prepared for that emotional piece. Well, what are you doing now, Randy?
Well,
we're 8 years. By the way, it's ironic. I just did the math. It was 8 years from when you went to that M&A seminar until you sold the business, and now it's 8 years since you sold the business. So now what?
So I've just recently picked up a company that I've been doing some fractional consulting with. So doing some fractional CEO work. And the guy, it's an $8 million company, and he's doing well. I mean, usually when they ask for third parties to come in and help them, it's because they're doing terrible. But he's trying to get his business. He wants to, get up in the 20 million plus club, and he just, fortunately has reached out, wants to, get some assistance in that. And I still do a lot of mentoring, Tom. I am still part of the entrepreneur organization, so I mentor. I've got 11 businesses that I mentor monthly, and that's kind of my give back. It kind of keeps me fresh and keeps me constantly hearing new challenges that entrepreneurs are having. And I'm, hopefully, I'd like to. Of course, I'm going to like to pick your brain a little bit, trying to do some podcasts and from that perspective. So that's kind of what I've been working on now. And I've gotten better at zoning in. As you know, as entrepreneurs, we love to chase the shiny pennies. And I'm the king of that. And so, but now I'm really looking in for the last, part of my life. And what I really enjoy is very similar to what you do is to get back and to help entrepreneurs be successful and to be in that 17% club.
Yes, that's my goal. I want everybody in the 17% club. I want to make it the 100% club, right? That every business owner can do that. And I love that about you, Randy. The entrepreneur organization, you mentioned it a couple of times here. It's just a fantastic organization. And there's other organizations like it, but you really should be kind of a part of a peer group, and EO gives a great, and YPO gives great opportunities to be able to do that. And I'm so glad that they have smart people kind of advising their entrepreneurs. That's awesome. Well, kind of one last business question here. I'm sitting here thinking about all the wisdom that you have just showered upon us today. But I have to ask you, if there was just one thing, if you had to boil down all of your advice to one thing that you wanted a business owner to do, of course, this podcast is all about maximizing business value. What's the one most important thing that you recommend business owners do to improve value of their business?
Put the we before the me. The we is the company. The me is you. If the we does well, you having equity in the we, you will do very well in the me when you sell the business. So when I realized that the business was a product, and you had mentioned an asset that's going to leave me one day, but it should give me a lot of money based on the sale of that asset. And you got to put that ego in play. And I mean, where it belongs, in the back seat of the car, not the front seat of the car, and definitely don't let it drive the car. And so I would just tell them, it's not about you. It's about the company. I know, I'm sorry. I know you're smart. I know you're the best business guy in the world, but I'm sorry. That's the truth. So.
No, you're absolutely right. It's about the business, and it's not your baby. So, all right, I have to ask a bonus question. Most of our listeners listen all the way to this point because they want to know, and I am really curious to find out, what personality trait has gotten you into the most trouble through the years, Randy?
Trying to be everybody's friend.
Really?
Trying to be always trusting what people said. And I got that's what got me in trouble with the partnerships. I just wanted everybody to be an entrepreneur, Tom. And I just thought if you had equity, and regardless if you paid for it or not, you would just naturally, you would be an entrepreneur, and you'd think like an entrepreneur and act and feel like one. But what I found out was you got to pay for it. You can't just get a house. You have to pay for the house to take care of the house, or the car. It's just, the rental car, you treat a rental car different than you treat the car you're paying for. And as much as I wish everybody could have that feeling that is what I'm talking about as well, what it's like to be an entrepreneur, what it's like to think the hell with this. Well, I don't even know why I wanted to do this. That day you want to quit. And then it's the next day that something happens and you say, damn, no, I'm not quitting. I'm going, we're going. I don't know how I'm going to make payroll this week, but we're going. So anyway, I got off on a tangent, but I made some mistakes where I just was too nice about something. And I hate to say the word too nice. I just said that there's certain things that have to be earned, and equity is one of them.
Well, and trusting people, I think it goes to that. I look back in my past, and to me, that wanting to be everybody's friend kind of goes to that whole trust issue. So many people tell me, well, you have to earn your trust with me. I trust everybody at face value until they prove otherwise. And once they prove otherwise, it's impossible to regain my trust. Right. And and I've been in some business situations that turned out just like that. Wow. That is a great answer to that question. I really appreciate you sharing that with us. How can our viewers and listeners get in touch with you?
Randy at pennystrategies.com.
Awesome. That is a great way to do that. Randy, thank you so much for giving us your wisdom and being our guest today.
Thank you, Tom. I really appreciate it. This was an honor to be a part of your show, and thank you.
You are quite welcome. So you can find Randy Haran on LinkedIn, or of course, you can always reach out to me and I'll be happy to make a warm introduction. This is the Maximize Business Value podcast, where we give practical advice to business owners on how to build long-term sustainable value in your business. Be sure to tune in each week and follow us wherever you found this podcast so you'll know every time that there's a new episode. And by the way, our regular listeners get the episode earlier than if you found this happenstance. So you'll be kind of the advanced team if you follow this podcast. And by the way, if you know someone who's exited their business successfully and therefore a member of the 17% Club who would like to be interviewed on this very podcast, be sure to reach out and let's schedule a conversation. So until next time, I'm Tom Bronson, reminding you that it's never too early to start planning your own ideal exit while you maximize business value.
Thank you for tuning into the Maximize Business Value podcast with Tom Bronson. This podcast is brought to you by Mastery Partners, where our mission is to equip business owners to maximize business value so they can transition on their terms. Learn more on how to build long-term sustainable business value and get free value-building tools by visiting our website, www.masterypartners.com. That's master with a Y, masterypartners.com. Check it out.
That was perfect. I wouldn't make any changes on that.